You know that feeling when you are standing at a checkout counter, and you swipe your card, and for just a split second, you hold your breath, not because you do not have the money, but because you are not really sure what is happening on the other side of that transaction. Is this good for me? Is this hurting me? Am I building something? Or am I slowly digging a hole I am going to spend years climbing out of? I have had that feeling. A lot of people I know have had that feeling. And what is strange is that credit cards have been around for decades. They are one of the most common financial tools in the world. And yet, most of us walk around with this low-level anxiety about them. Like we know they are powerful, but we are not quite sure if we are using them right, or using them at all the way they were designed to be used. And here is the thing that nobody tells you up front. That anxiety you feel, it is not a personal failure. It is not because you are bad with money. It is because nobody ever sat you down and actually explained how this whole system works. Not just the surface stuff, not just pay your bill on time, but the real mechanics underneath. The psychology, the traps, the actual rewards, the credit score math, the interest rate games. All of it. That is what this video is. I want to be the person who actually sits down with you and walks you through everything, from the very basics to the advanced stuff, in a way that feels human and real and does not make you feel stupid for not already knowing it. By the time this is over, you are going to feel something you probably have not felt about credit cards before. Clarity. Not excitement, not fear. Just calm, grounded clarity. And that changes everything. Section 2. Reframing the problem. Let me start with something that might sound obvious but actually runs pretty deep. Most people think of a credit card as either a convenience tool or a danger zone. You either treat it like a magic debit card, swipe it everywhere, and ignore the bill until it becomes a problem. Or you are so scared of debt that you avoid credit cards entirely, quietly proud of yourself for not needing one. Both of those approaches on the surface seem reasonable, but both of them are actually leaving you worse off than you need to be. Here is the thing about credit cards that the financial industry does not exactly rush to advertise. They are a system built to profit from your confusion and your habits. The companies that issue credit cards are extraordinarily good at what they do. They have entire behavioral psychology teams. They have data on how people spend, when they spend, what makes them spend more. They have designed the rewards programs, the interest structures, the minimum payment options, all of it around human psychology, around the way our brains work. And when you do not understand the system, you play by their rules. When you do understand it, you can actually flip things in your favor. Not completely. They still win in the aggregate. But for individuals who understand the game, credit cards can be genuinely useful tools. Now, I am not going to pretend this is going to be easy, or that there are no risks. If you carry a balance, if you are already in debt, credit cards can make things harder. That is real. But the answer is not to stay in the dark. The answer is to actually learn how this works, because you are probably going to have a credit card at some point in your life regardless, and you deserve to know what you are dealing with. Let me also challenge one more belief before we go deeper. The idea that credit cards are just for people who cannot afford things. That narrative, that credit cards are a last resort, a sign of financial weakness. It is both inaccurate and unfair. Some of the wealthiest people in the world put everything on credit cards. Not because they need to, but because they understand that, used correctly, credit cards offer real, tangible financial benefits. We will get into all of that. But first, let us build the foundation. Let us start from the very beginning. What a credit card actually is. Section 3. What a credit card actually is. At its most basic level, a credit card is a short-term loan. When you swipe your card at a store, you are not spending your own money in that moment. The credit card company is paying that merchant on your behalf. Then, at the end of the billing cycle, usually a month, they send you a bill. If you pay it in full, you have essentially borrowed money for free for up to 30 days. If you do not pay it in full, they start charging you interest on what you owe. That is the core mechanism. Everything else, rewards, credit scores, cashback, travel points, all of it is built around that fundamental structure. Now, what makes credit cards different from other types of loans? A few things. First, they are revolving credit. Unlike a car loan or a personal loan where you borrow a fixed amount and pay it down over time, a credit card gives you a credit limit, and you can borrow up to that limit, pay it back, and borrow again, over and over. It revolves. Second, the interest rates are generally much higher than other forms of borrowing. We are talking average rates around 20 to 24% annually in the current environment. That is not a typo. If you carry a balance on a credit card for a year, you are paying roughly 20 to 24% extra on top of whatever you originally charged. Compare that to a mortgage at 6 or 7%, or even a car loan at 8 to 10%. Credit card interest is expensive. Very expensive. Third, the minimum payment trap. This is one of the cruelest designs in consumer finance. And I want you to really hear this. Credit cards allow you to pay only a tiny minimum each month, sometimes as little as 1 to 2% of your balance, or a flat fee like $25. They make this option extremely easy and almost comfortable. But here's what happens when you only pay minimums. Your balance barely shrinks. The interest keeps compounding. A $3,000 balance at 22% interest where you are only paying minimums could take more than a decade to pay off and cost you thousands in interest, thousands, on $3,000. That is not an accident. That is a feature. From the bank's perspective, understanding this one thing, really internalizing it, is worth more than almost anything else in this video. Credit cards are free when you pay in full. They are extremely expensive when you do not. Now let us talk about who the players are in this system, because understanding the structure helps everything else make more sense. When you have a credit card, there are typically a few parties involved. There is the card network: Visa, MasterCard, American Express, Discover. These are the infrastructure companies. They are the highway that transactions travel on. Then there is the issuing bank: Chase, Bank of America, Citi, Capital One, and hundreds of others. The issuing bank is the one that actually lends you the money, sets your interest rate, determines your credit limit, and collects the payments. And then there is the merchant, the store or restaurant or website where you are spending. When you swipe your card at a coffee shop, here is what actually happens in about 2 seconds. Your card information goes to Visa's network. Visa routes it to Chase, or whoever your bank is. Chase confirms you have available credit and approves the transaction. And then Chase pays the coffee shop, minus a small fee called an interchange fee, usually around 1.5% to 3% of the transaction. The merchant pays that fee every single time. That is actually one of the ways the credit card companies fund their rewards programs. They take a cut from merchants on every transaction, and some of that gets passed back to cardholders in the form of points or cashback. This is important context for later when we talk about rewards. The game is more interconnected than it looks from the outside. Section 4. Credit scores, the number that shapes your financial life. Okay, let us talk about credit scores because this is probably the topic that causes the most anxiety and the most confusion, and it is genuinely important. Your credit score is a 3-digit number, typically ranging from 300 to 850. That represents your credit worthiness. It is an attempt to quantify the answer to one question. If we lend this person money, how likely are they to pay it back? The most widely used scoring model is called FICO, created by the Fair Isaac Corporation. When a lender, a bank, a landlord, a car dealer, sometimes even an employer, wants to evaluate you financially, they typically pull your credit score as part of that evaluation. A higher score means you are considered lower risk, and lower risk means better loan rates, higher credit limits, easier approvals. The practical impact of your credit score is significant. Someone with an excellent credit score might get a mortgage at 6.5%. Someone with a poor credit score might be offered the same mortgage at 8.5% or get denied entirely. On a $300,000 home over 30 years, that 2% difference in interest rate means paying roughly $130,000 more over the life of the loan. That is not a small number. That is a car. That is multiple years of living expenses for many families. So how is your credit score actually calculated? Let me walk you through the 5 main components, and I will tell you which ones matter most. Payment history is the biggest piece. It accounts for about 35% of your score. This is simple. Did you pay your bills on time? Every on-time payment builds your score. Every late payment hurts it. A single missed payment can drop your score significantly, sometimes by 50 to 100 points or more depending on where you started. And it stays on your credit report for 7 years. 7 years. I am not saying this to scare you. I am saying it so you understand why, if there is only one thing you do, it should be paying at least the minimum on time every single month. Set up autopay for the minimum. That alone protects 35% of your score. The second component is credit utilization, which accounts for about 30% of your score. This one is less intuitive and less well understood. Credit utilization is the ratio of how much credit you are using to how much credit you have available. If you have a credit card with a $5,000 limit and you have charged $4,500 on it, your utilization on that card is 90%. That is very high, and it will hurt your score. Generally, keeping your utilization below 30% is considered good. Below 10% is even better for score optimization. Here is what surprises most people. Utilization is calculated at a specific point in time, usually the statement date when your balance gets reported to the credit bureaus. So even if you pay your bill in full every month, if your balance on the statement date is high, your reported utilization is high. We will talk about how to manage this strategically in the practical section. The third component is length of credit history, which is about 15% of your score. This includes the age of your oldest account, the age of your newest account, and the average age of all your accounts. In general, older is better. This is one of the reasons financial advisors often say do not close your oldest credit card. Even if you do not use it much, keeping it open maintains that age history. The fourth component is credit mix, about 10% of your score. Lenders like to see that you can manage different types of credit responsibly. Credit cards, student loans, car loans, mortgages. Having a variety all paid on time generally helps your score. You do not need every type, and this should not drive major financial decisions, but it is worth understanding. The fifth component is new credit inquiries, also about 10%. When you apply for new credit, the lender typically does what is called a hard inquiry on your credit report. This temporarily lowers your score by a small amount, usually 5 to 10 points, and it stays on your report for 2 years. Multiple applications in a short period can compound this. The score bounces back over time, but it is worth being thoughtful about how often you apply for new credit. Now, what is a good credit score? Here is a rough breakdown of the ranges. 300 to 579 is generally considered poor. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good. 800 and above is exceptional. The sweet spot most financial advisors talk about is getting above 700 as a baseline, and ideally above 740 to unlock the best rates on mortgages and major loans. One thing I want to normalize: if your credit score is low right now, it is not permanent. It is not a verdict. It is a snapshot that changes. The steps we will talk about later can meaningfully improve a credit score over 12 to 24 months. I have seen people go from 580 to 720 in under 2 years with consistent, deliberate behavior. Not magic, just understanding the system. Section 5. How interest works, the math they hope you do not do. Let us spend some real time on interest, because this is where so much damage happens. And the math is actually pretty simple once you see it laid out. Your credit card's interest rate is expressed as an APR, annual percentage rate. If your APR is 22%, that means you are being charged 22% per year on any balance you carry. But credit cards do not compound annually, they compound daily. The daily periodic rate is your APR divided by 365. So 22% divided by 365 is about 0.06% per day. That sounds tiny. But here is the thing about compounding interest. It is relentless. Every day the interest gets calculated on your current balance, including the interest that was already added. It grows on itself. That is the magic of compounding that works beautifully in your favor when you are investing, and works devastatingly against you when you are in debt. Let me give you a real example. Say you charge $2,000 on a credit card at 22% APR. Life gets complicated. You cannot pay it off right away, and you start making the minimum payment. Let us say the minimum is $50 a month. How long do you think it takes to pay that off? It takes over 8 years, and you end up paying approximately $2,700 in interest on top of your original $2,000. So you borrowed $2,000 and you paid back nearly $4,700. That is the real cost. Now if you paid $100 a month instead, about 2 years and 4 months, and only around $550 in interest total. Same original balance, same interest rate. Just paying double the minimum makes an enormous difference. This is why, when you are carrying a balance, the most guaranteed return you can get on your money is paying off high-interest debt. There is no investment that gives you a guaranteed 22% return. Paying off a 22% credit card balance is mathematically equivalent to earning 22% on that money. That is extraordinary. Now let us talk about grace periods, because this is one of the most important and least understood concepts. Most credit cards have a grace period, typically 21 to 25 days after the end of your billing cycle, during which you can pay your full statement balance without being charged any interest at all. This is the window that makes credit cards actually free to use when you are on top of your balance. Here is how it works in practice. Your billing cycle closes on the 15th of the month. Your statement balance gets locked in. Let us say it is $800. You then have until roughly the 10th of the following month to pay that $800. If you pay it in full, zero interest. You just got to borrow $800 for free for potentially 45 days. But here's the critical detail. If you carry any balance from the previous month, many cards eliminate the grace period entirely. Now, interest starts accruing immediately on new purchases from the day you make them, with no grace period at all. This is called losing your grace period. and it significantly increases your borrowing costs. This is why getting to a zero balance state is so valuable. Not just financially, but structurally. Once you are carrying a balance, the system is more expensive and more complex to manage. One more thing on interest. Promotional rates. You have probably seen offers for 0% APR for 12 months or 18 months. These are real and they can be genuinely useful if handled correctly, but they come with a trap you need to know about. Some 0% promotional offers have what is called deferred interest, not the same as no interest. With deferred interest, if you do not pay off the entire balance before the promotional period ends, all the interest that would have accrued during that period gets added to your balance retroactively. All of it. So if you had an $1,800 balance on a 12-month 0% deal and you paid it down to $200, still have $200 left when the promo ends, you could suddenly owe not $200, but $500 or more, because all 12 months of interest gets charged at once. Real 0% APR offers do not work this way. After the promotional period, interest only accrues going forward on whatever balance remains. No retroactive charges. The deferred interest version is much sneakier, and it tends to appear in store credit cards from retailers, furniture stores, electronic stores, and medical offices. Read the fine print. Specifically look for the phrase deferred interest. If you see it, that is a materially different product than a true 0% APR offer. Section 6. Types of credit cards. There are so many credit cards on the market that trying to compare them without a framework can feel overwhelming. So let me give you that framework. Credit cards fall into a few broad categories, and knowing which category fits your situation is the foundation of making a good choice. The first category is secured credit cards. These are designed for people who are new to credit or rebuilding damaged credit. With a secured card, you put down a cash deposit, usually $200 to $500, and that deposit becomes your credit limit. You are essentially borrowing against your own money, which means the bank takes on almost no risk. In exchange, they report your payment activity to the credit bureaus just like any other credit card. So you are building real credit history, even though the mechanics feel different from a traditional card. Most secured cards do not have great rewards, and some have fees, so they are a stepping stone, not a forever card. The second category is student credit cards. These are designed for people in college or just starting their financial lives. They typically have lower credit limits, no income requirements, and sometimes offer modest rewards or cash back. They are easier to qualify for and can be a great way to start building credit responsibly. The third category is starter unsecured cards. These are cards for people with limited or fair credit, maybe a score in the 580 to 670 range. They often have higher interest rates to compensate for the perceived risk, lower limits, and fewer perks. They are not glamorous, but they are stepping stones. The fourth category is cashback cards, and this is where things start getting genuinely interesting. Cashback cards give you a percentage of your spending back as cash, typically 1 to 5% depending on the category. There are flat rate cards that give you the same percentage on everything, often 1.5% or 2%, and category cards that give you higher percentages in specific areas like groceries, gas, dining, or online shopping. A simple example: the Citi Double Cash Card gives you 2% back on everything. 1% when you buy, 1% when you pay. If you put $2,000 a month on the card and pay it in full, that is $480 per year. Free money essentially for spending you were going to do anyway. Category cards can yield more if your spending matches the categories. Some cards give 5 or 6% back on groceries and 3% on gas. If your household spends $800 a month on groceries, that 6% is $576 a year just on that one category. The fifth category is travel rewards cards. And this is probably the most complex and the most lucrative for the right person. Travel cards earn points or miles instead of cash, and those points can be redeemed for flights, hotels, and other travel, often at a value that exceeds what cashback would give you, if you know how to use them. We will dig deep into this later. The sixth category is balance transfer cards. These are specifically designed to help people move high-interest debt from one card to another at a lower rate, often 0% for an introductory period of 15 to 21 months. If you are carrying a balance on a high-interest card, a balance transfer can save you significant money in interest while you pay it down, but they typically come with a balance transfer fee of 3 to 5% of the amount transferred. The seventh category is business credit cards. If you are self-employed, a freelancer, or run any kind of business, business cards offer higher limits, expense tracking, and often strong rewards on business spending categories like office supplies, advertising, internet, and phone bills. They also help separate business and personal spending, which is valuable both for clarity and for tax purposes. And then, There are premium cards, the high annual fee cards like the American Express Platinum and Chase Sapphire Reserve and similar. These cards charge anywhere from $250 to $700 or more per year, but they come loaded with benefits. Airport lounge access, travel credits, high-earning reward rates, purchase protections, and more. Whether a premium card makes sense depends entirely on whether you can extract more value from the benefits than you pay in the annual fee. Section 7. Rewards programs, how they actually work. Let us talk about rewards, because this is where most people either get excited and get lost, or they decide it is too complicated and leave real money on the table. First, let me give you the honest picture. Rewards credit cards are a wealth transfer, from merchants via interchange fees, and from cardholders who pay interest and fees, to cardholders who pay in full and understand the system. If you are paying interest on a rewards card, the interest charges will almost always exceed whatever rewards you are earning. It is not even close. A 22% interest rate versus 2% cashback. You are paying 10 times more in interest than you are earning in rewards. So the foundational rule is this: rewards only make sense if you pay in full every month. The moment you are carrying a balance, the math flips against you dramatically. Assuming you are in a position to pay in full, let us talk about the three main reward systems. Cashback is the simplest and most straightforward. You earn a percentage of your spending back, and it shows up as a statement credit or a deposit to your bank account. No complexity, no expiration worries, no award chart to study, just money back. For people who do not want to spend time optimizing their credit cards, a good cashback card is genuinely excellent. Then there are points and miles systems. These work differently from cashback in a few important ways. Points and miles do not have a fixed value. Their value depends entirely on how you redeem them. A Chase Ultimate Rewards point might be worth 1 cent if you redeem for cash, 1.25 cents if you use it to book travel through Chase's portal, or potentially 2 cents or more if you transfer it to a partner airline or hotel loyalty program and book award travel. Same points, dramatically different value. This is where the travel optimization world lives, and it can be genuinely impressive. Families have booked business class flights to Europe, tickets that would retail for $5,000 to $7,000 each, for 60 to 80,000 points. Points they earned by putting their regular spending on the right cards and occasionally taking advantage of sign-up bonuses. But I also want to be real with you. The complexity of optimizing point systems is real. It requires tracking transfer partners, understanding sweet spots in award charts, being flexible with travel dates, and putting in research time. For some people, that is a fun puzzle. For others, it is genuinely more stress than it is worth. Both are valid reactions. Let us talk about sign-up bonuses, because these are often the highest value thing in credit card rewards, and also one of the most misunderstood. Most rewards cards offer a large sign-up bonus if you spend a certain amount within the first few months of opening the account. Something like earn 80,000 points after spending $4,000 in the first 3 months. 80,000 points, if used well, might be worth $800 in cash back value, or $1,200 to $1,600 in travel value. The trap with sign-up bonuses is that the spending requirement can lead people to spend money they would not otherwise spend, just to hit the threshold. If you are buying things you do not need to earn 80,000 points, you have likely paid more for those things than the points are worth. The sign-up bonus is only actually beneficial if you can meet the spending requirement through normal, already planned purchases. That said, if you have a large purchase coming up, new appliances, a car repair, a home renovation deposit, a vacation you have already saved for, timing a card application to catch that spending in the bonus window is a legitimate and smart strategy. One more concept: the annual fee calculation. Many people avoid cards with annual fees instinctively. That is understandable, but the math does not always support avoiding them. If a card charges a $95 annual fee but offers benefits that you will actually use worth more than $95, the card is paying for itself. Do the math specific to your life. Do not accept or reject based on the fee alone. Section 8. The psychology of spending. I want to step back from the mechanics for a moment and talk about something that is just as important: the psychology. Because here is the uncomfortable truth. Credit cards change how we experience spending, and understanding that is essential to using them wisely. There is a fascinating body of research from MIT and behavioral economists showing that people spend more when they pay with credit cards versus cash. The effect is significant, sometimes 12 to 18% more. The reason comes down to something called the pain of paying. When you hand over physical cash, your brain registers a loss. You can literally see the money leaving your hand. That visceral, immediate experience creates a kind of friction, that makes you think twice before large purchases. Cash is painful to spend in a psychological sense. Credit cards disconnect that moment of spending from the moment of payment. When you tap your card, there is no immediate, tangible loss. The bill comes later. Abstract. Future. Disconnected from the present pleasure of buying the thing. Your brain processes the purchase differently. The reward center gets activated because you are getting something, without the immediate loss register because the money does not disappear right now. This is not a character flaw. This is just how human brains work. We are wired to respond to immediate concrete events more powerfully than future abstract ones. Credit cards exploit that wiring systematically. What is the practical implication? If you are someone who tends to overspend when you are not using cash, credit cards require an extra layer of intentionality. Some strategies that help. Track your spending weekly, not just monthly. Do not wait for the monthly statement to see where you stand. Check your credit card app regularly so your spending stays concrete and visible. Use the envelope mentality mentally. Allocate your credit card spending to categories before the month begins, not just after. There is also the phenomenon of credit card rewards adding to this problem. When you are earning points or cash back, your brain gets an additional positive signal. Not only do you get the thing you bought, but you are also earning something. This can create a subtle rationalization loop where overspending feels justified because of the rewards. I am getting 3% back on this, your brain whispers, as you add something unnecessary to the cart. Rewards are real, but they only matter in the context of your total financial behavior. 2% cash back on a $500 unnecessary purchase is $10. The unnecessary purchase is still $500. None of this means you should not use credit cards. It means use them with your eyes open, with the full awareness that the system is designed to make spending feel frictionless, and that friction in some doses is actually protective. Section 9. Common credit card traps. Let me walk you through the traps. The real ones. Not the obvious do not go into debt advice, but the specific, often subtle ways people end up worse off than they expected. The first trap is the minimum payment comfort zone. We touched on this, but I want to come back to it because it is so psychologically insidious. Credit card companies make the minimum payment option very comfortable. The bill arrives, you see minimum payment due $35, and paying that $35 feels responsible. You paid the bill, but you have barely reduced the principal. And next month, the interest has grown, and the balance is almost the same. This is a treadmill, a very expensive treadmill. The minimum payment is designed to keep you in debt as long as possible. It is not a guideline for good financial behavior. It is the floor of what you legally have to pay to avoid a late fee. That is all it is. The second trap is the credit limit as a budget. Your credit limit is not your budget. Your credit limit is how much the bank is willing to lend you. Those are completely different things. If your credit limit is $8,000 and you treat it as available spending money, you are setting yourself up for a slow, painful collision with reality when the bill arrives. Your actual budget is what you can afford to pay off in full at the end of the month. The third trap is interest rate creep. You open a card at 18% APR. That feels manageable. Over time, you start carrying a balance. Life happens. Maybe the rate gets adjusted upward. Now you are at 24% and the balance has grown and you are deep in an expensive hole that crept up onto you gradually. The fourth trap is the retail store card. I need to talk about these specifically because they are everywhere and they are frequently a bad deal. You are at the checkout and the cashier says, "Would you like to save 20% today by opening our store card?" The 20% discount is real and immediate. The card's 29% interest rate is real and ongoing. If you pay the balance off immediately, you get the discount and there is no harm. But a lot of people open that card with good intentions, and then the balance lingers. And retail store cards tend to have the highest interest rates of any credit product, often 25 to 30%. Retail store cards can make sense in specific circumstances. If you shop there constantly and they have genuine rewards, or if you are disciplined about paying in full. But going in with clear eyes matters. The fifth trap is carrying a balance on a rewards card. Rewards cards tend to have higher interest rates than no-frills cards. The rewards only make sense without interest. If you are carrying a balance on a rewards card at 24%, no amount of cashback or points is going to compensate for that cost. The sixth trap is the balance transfer misuse. Balance transfer cards can be genuinely helpful. Move high-interest debt to 0% for 18 months. Pay aggressively. Come out ahead. But here is the trap. Some people do the balance transfer, feel relief from the lower payment, and then continue using the original card, running up more debt. Now they have the old balance on a new card and a new balance on the old card. They have doubled their problem. A balance transfer is a tool for paying down debt, not a magic reset button. It only works if you stop the spending that created the debt in the first place. The seventh trap is over-applying for credit. Opening many new credit accounts in a short period can signal to lenders that you are in financial distress, even if you are not. It can trigger limit decreases on existing cards, higher risk assessments on future loan applications, and general negative attention from lenders. Be thoughtful and deliberate about credit applications. 1 or 2 new cards a year is generally manageable. More than that, and you start seeing cascading effects. Section 10. The turning point. I want to pause here and shift the energy of this conversation, because we have been through a lot of the hard stuff. The interest, the traps, the psychology. And I do not want you to leave this section feeling defeated or scared. Here is the mindset shift I want to offer you. Credit cards are not inherently evil. They are not inherently good. They are tools with specific properties. And like any tool, the outcome depends on whether you understand how to use it and whether you are using it for the right job. A hammer is a fantastic tool. If you use it to drive nails, you build things. If you misuse it, you damage things. Nobody blames the hammer. The problem is not credit cards. The problem is that we were handed these powerful financial tools without an instruction manual, without context, often when we were 18 and had no framework for how money actually works. And then we were surprised when we made mistakes that the system was in some ways designed to encourage. What I want you to feel coming out of this video is a kind of calm competence, the sense that you understand what is happening, and you can make intentional choices, not perfect choices. Perfect does not exist, but intentional ones. The person who uses credit cards well is not some financial genius with an MBA. They are just someone who has 3 habits. They pay in full every month. They track their spending honestly. And they choose cards that match how they actually live, rather than how they wish they lived. That is it. Those 3 things change the entire experience. And here is what is really interesting about building that kind of relationship with credit cards. When you are in control, the benefits start to feel real. You earn rewards on spending you were going to do anyway. You build a credit history that gives you access to better mortgage rates, lower insurance premiums in many states, and easier housing applications. You have a layer of consumer protection that debit cards often lack. You get fraud protection, extended warranties, purchase protection, travel insurance. These are real, meaningful benefits. The system that was designed to profit from your confusion can, when you understand it, work genuinely in your favor. That is the turning point. Section 11. Building credit from scratch or rebuilding. Let us talk about real-world starting points, because people come to this topic from very different places. If you are starting from zero, you are 18, 19, maybe 20 years old. Maybe just out of college. No credit history. The situation can feel frustrating. You need credit to build credit. It feels circular, but there are paths forward. The easiest path for most people starting from zero is a secured credit card or a student card. Apply for one of these. Put a small amount on it every month. Maybe a subscription service or gas. And pay it in full every month. That is it. You are building credit history. After 6 to 12 months of consistent payment history, you will have enough of a credit file for most issuers to consider you for unsecured cards. Some banks also offer what are called credit builder loans, small loans specifically designed to help people establish credit history. The money from the loan often goes into a savings account that you cannot access until the loan is paid off. Each monthly payment gets reported to the credit bureaus. It is a somewhat circular product, but it serves its purpose. If you have a trusted family member with good credit, being added as an authorized user on their account can also help. Their account history, including the age of the account and payment history, may get added to your credit report. This can meaningfully boost a thin credit file. Now, what if you are rebuilding? Maybe you had a rough financial period, job loss, medical bills, divorce, just young and unaware, and your credit took a hit. Maybe you have some late payments on your report, maybe even a collection account. This feels awful, I know, but it is recoverable. First, let us understand the timeline. Most negative items stay on your credit report for 7 years. Bankruptcies can stay for 10. Within those timelines, though, the impact of negative items decreases over time. A late payment from 5 years ago matters much less than one from 6 months ago. The older the negative item, the less it drags your score. Here is the practical rebuilding path. Step 1. Get your credit reports and actually look at them. You can pull your reports for free once a year at annualcreditreport.com. That is the official government-mandated free access. Look through each item. Are there errors? Incorrect late payments? Accounts that are not yours? Errors on credit reports are more common than people think, and disputing them through the credit bureaus can sometimes result in significant score improvements. Step 2. Address any open collections or charged-off accounts you can realistically resolve. This is nuanced. Paying old collections does not automatically remove them from your report. The record of the collection stays. Only the balance might change to zero. But having unpaid collections can affect your ability to qualify for certain things. Use judgment here based on the age and amount. Step 3. Get a secured card or a credit builder product and start building new positive history. Positive, consistent payment history is the most powerful tool for rebuilding credit over time. It does not happen overnight, but it compounds. Each month of clean payment history adds to your foundation. Step 4. Be patient and intentional. Do not apply for many cards at once. Focus on making every payment on time. Watch your utilization. After 12 months of disciplined behavior, check your score again. Most people see meaningful improvement. Section 12. How to choose the right credit card. This is where the practical rubber meets the road. How do you actually choose a card? The honest answer is it depends. And that answer is frustrating, I know. But it is the right answer. Because the best credit card for someone who travels frequently for work is completely different from the best card for a single parent managing a tight grocery budget. Let me give you a framework. Start with a self-audit of your spending. Before you look at a single card, spend 10 minutes looking at where your money actually goes in a typical month. Not where you wish it went, where it actually goes. For most households, the big categories are groceries, dining out, gas, online shopping, subscriptions, and travel. Knowing your actual spending profile is the foundation of any good card decision. Then ask yourself, am I in a position to pay in full every month? If the honest answer is no, or not yet, then the conversation about rewards is premature. Your priority card right now is either a low-interest card or a 0% APR card to help you eliminate debt before you optimize for rewards. No rewards card will outperform the cost of interest. If you can pay in full, then it is about matching the card to your lifestyle. If simplicity matters most to you, and you do not want to think about categories, a flat-rate 2% cashback card on everything is genuinely excellent. Set it up, use it, pay it off, and enjoy $400 to $800 a year in cashback on typical household spending. If you spend heavily in specific categories, a combination approach often works well. Many people run a primary plus secondary card strategy. One card for high-category spending, like a card that gives 6% on groceries and 3% on dining. And one card for everything else, a flat 2% on whatever the category card does not cover. With a bit of attention, you can earn 3 to 4% blended return on your spending. If you travel frequently and you are comfortable with some complexity, travel rewards cards can offer dramatically higher value. The key is choosing the right travel ecosystem. If you fly United predominantly, a co-branded United card and transferring points to United makes sense. If you fly whatever is cheapest, a more flexible points currency like Chase Ultimate Rewards or American Express membership rewards is better because you can transfer to multiple airline and hotel partners. If you are starting out, do not let perfection be the enemy of good. A student card or secured card that you use responsibly is infinitely better than paralysis from trying to pick the optimal card when you are not yet in the position to fully benefit from rewards. Now let me mention a few specific card archetypes that consistently perform well. For no annual fee cash back, the Citi Double Cash gives 2% on everything. The Wells Fargo Active Cash also gives 2% on everything. The Discover It Cash Back gives 5% on rotating categories and 1% on everything else. For no annual fee grocery and dining, the Blue Cash Everyday from American Express gives 3% on U.S. supermarkets, 3% on U.S. gas, and 3% on online retail. The Capital One Saver One gives 3% on dining, groceries, and entertainment. For mid-tier travel with a $95 annual fee, the Chase Sapphire Preferred gives 3 times points on dining and travel, with strong transfer partners and solid travel protections. The Capital One Venture gives 2 times on everything with flexible redemption. For premium travel, the Chase Sapphire Reserve gives a $300 annual travel credit that effectively reduces the net fee 3 times on travel and dining, and Priority Pass lounge access. The American Express Platinum gives 5 times on flights and has extensive travel benefits. For balance transfer, the Citi Simplicity and Wells Fargo Reflect both offer 0% for up to 21 months on transfers. For rebuilding credit, Capital One Platinum, Discover It Secured, and Open Sky Secured are solid options. And I want to be clear, these are examples of cards that have historically offered strong value in their categories. Rates, terms, and offers change. Always verify the current offer before applying. Section 13. Credit card protection benefits. This section does not get enough attention, and it genuinely surprises people when they learn about it. Many credit cards, especially Visa Signature and MasterCard World products, come with a suite of built-in protections that most cardholders never use because they do not know they exist. Let me walk you through the main ones. Purchase protection covers items you buy against damage or theft for a period of time, often 90 to 120 days from purchase. Say you buy a new laptop, carry it in your bag for 2 months, and it gets stolen. File a claim through your card's purchase protection, and you may get reimbursed. Limits vary, often $500 to $10,000 per claim, and there are exclusions. But for electronics, jewelry, and similar items, this is meaningful coverage. Extended warranty protection automatically extends the manufacturer's warranty on items purchased with the card, often by 1 additional year. On electronics that come with a 1-year warranty, this effectively doubles your coverage at no additional cost. When you are buying something like a TV, a camera, or a laptop, this benefit alone can be worth more than any cashback you would earn on the purchase. Return protection is a less common but genuinely useful benefit offered by some cards. If a merchant will not accept a return within a certain period, often 90 days, your credit card may let you return the item for a refund anyway, up to certain limits. Travel insurance is where premium cards really differentiate themselves. Benefits can include trip cancellation and interruption insurance. If your trip is canceled for a covered reason, you get reimbursed for non-refundable prepaid expenses. Trip delay coverage. If your flight is significantly delayed, reimbursement for meals in hotels, lost luggage reimbursement, and emergency evacuation insurance. The Chase Sapphire Reserve, for example, offers up to $10,000 per trip in cancellation coverage and up to $500 in delay coverage per incident. These are real insurance products, not marketing fluff. Rental car insurance is another underutilized benefit. Many credit cards offer primary or secondary rental car collision coverage when you charge the rental to the card and decline the rental company's collision waiver. Primary coverage is better. It pays before your own auto insurance does, meaning no claims filed with your own insurer, no premium increases. Before you reflexively add the rental company's $30 a day collision waiver, check what your credit card already covers. Cell phone protection is an increasingly common benefit on mid-tier cards. If you pay your cell phone bill with the card, you are covered for phone damage or theft, usually up to $600 to $800 with a small deductible. This can make a separate cell phone insurance plan unnecessary. To actually use any of these benefits, you need to know they exist, know the claim process, which is usually calling the benefits administrator number on the back of your card or on the card's website, and document your purchases. Keep receipts, take photos, know your coverage limits. Section 14. Credit cards and fraud protection. One of the genuinely powerful consumer protections that comes with credit cards is fraud liability. Under federal law in the United States, if someone makes unauthorized charges on your credit card, your maximum liability is $50. And most major card issuers have zero liability policies, meaning you are not responsible for any fraudulent charges at all, as long as you report them promptly. Compare that to debit cards. If you report unauthorized debit card charges within 2 business days, your liability is capped at $50. But if you wait 2 to 60 days, it can go up to $500. And after 60 days, you could be liable for everything lost. More importantly, and this is significant, when your debit card is compromised, the money is already gone from your bank account. You are waiting to get it back, often while bills are due and your real balance is depleted. With a credit card, fraudulent charges show up as charges to the bank's money, not yours. You dispute it, the bank investigates, and you do not pay it. This asymmetry is one of the reasons many financial advisors recommend paying for online purchases and significant transactions with credit cards rather than debit cards. The consumer protection layer is meaningfully better. If you notice fraudulent charges on your credit card, act quickly. Call the number on the back of your card immediately. The bank will cancel the card and issue a new one. The fraudulent charges get disputed. In most cases, resolution takes a few weeks, and you are made whole. Also worth knowing, chip cards and virtual card numbers have made fraud harder. Most major issuers now allow you to generate a virtual card number, a unique card number that maps to your real card, for online transactions. If that virtual number gets compromised, you can cancel just that number without it affecting your real card. Privacy.com is a popular third-party service for this if your card does not offer it natively. Section 15. The advanced game. Card stacking and ecosystem building. If you have been using a single credit card and paying it off, You have got the foundation. This section is about the next level, how thoughtful people build a small portfolio of cards that works together to maximize value. I want to be clear up front. This level of optimization is not for everyone. If managing multiple cards adds complexity and stress to your life, one excellent card used well is better than 4 cards used poorly. Know yourself. But for people who enjoy this kind of optimization, or who are curious about how it works, let me walk you through the philosophy. The core idea is that different cards have different strengths in different categories. By combining 2 or 3 cards strategically, you can earn significantly higher rewards on your actual spending compared to any single card. A classic combination example: Chase Sapphire Preferred gives 3 times points on dining and travel, paired with Chase Freedom Unlimited, which gives 1.5 times on everything else. But here is the key detail. The Freedom Unlimited earns ultimate rewards points that can be transferred to the Sapphire account, which has better redemption options including transfer partners, so you are effectively getting Sapphire's premium redemption value on all your Freedom Unlimited spending. Add a third card like the Chase Freedom Flex, which rotates 5% categories quarterly, and you have a stack that earns 5% in rotating categories, 3% on dining and travel, and 1.5% on everything else, all in the same transferable points currency. American Express has a similar ecosystem. The Amex Blue Cash Preferred earns strong cash back at U.S. supermarkets and gas. The Amex Gold earns 4 times at restaurants and U.S. supermarkets in membership rewards points. The Platinum earns 5 times on flights. Together, they cover high-value categories with premium earning rates. Capital One also has a transferable point system. Venture X earns 2 times on everything with airport lounge access and strong travel transfer partners. The most important thing about choosing an ecosystem is picking one and going deep into it. Spreading your spending across many different card ecosystems means your points balances in each program are too small to redeem for anything meaningful. Concentration gives you the ability to actually use your rewards. When thinking about annual fees in a portfolio context, add them all up. If you are paying $95 plus $95 plus $95, that is $285 a year in annual fees across 3 cards. You need to be extracting more than $285 in incremental value from those cards compared to free cards. Do the math honestly. Also understand that credit card issuers have rules about applications. Chase famously has the 5/24 rule. They will not approve you for most of their cards if you have opened 5 or more personal credit cards from any issuer in the last 24 months. American Express has a rule about welcome offers. You can generally only receive the welcome offer on each of their cards once per lifetime. Capital One limits you to 1 personal card application per 6 months. Knowing these rules helps you sequence your applications strategically. Section 16. Credit cards and major life moments. Let me talk about some specific situations where credit cards intersect with big life decisions, because context matters a lot here. Buying a home. Your credit score significantly affects your mortgage rate. If you are planning to buy a home in the next 1 to 2 years, this is not the time to be opening new credit cards, closing old ones, or carrying high utilization. Your score needs to be stable and as high as possible. Lenders pull your credit multiple times during the mortgage process, sometimes even the day of closing. Any negative changes between pre-approval and closing can jeopardize your loan. Be conservative with your credit in the months leading up to a home purchase. Getting a car. Same basic principle. If you are financing a car, lenders will check your credit. Your score determines your interest rate. Even a half percentage point difference in a car loan rate over 5 years adds up to hundreds or thousands of dollars. Be thoughtful. Starting a business. Business credit cards can be excellent tools for entrepreneurs. They typically offer higher limits than personal cards, strong category rewards on business spending, and expense tracking features that simplify accounting. They also help establish a business credit profile separate from your personal credit. Though in the early stages of a business, most business cards require a personal guarantee, meaning your personal credit is still involved. Having a major medical expense. If you are facing a large medical bill, a 0% APR credit card or a balance transfer card can sometimes be a useful tool for managing that cost without paying high interest rates immediately. However, hospitals and healthcare providers often have their own 0% or low-interest payment plans. Always ask about those first before putting large medical bills on credit. During financial hardship. If you have lost a job, experienced a health crisis, or are going through divorce or other financial disruption, credit card debt can become critical quickly. A few things worth knowing. Issuers often have hardship programs where they can temporarily reduce your interest rate or minimum payment if you call and explain your situation. This requires actually calling them proactively before you miss payments. Many issuers have these programs but do not advertise them widely. A credit counseling nonprofit, look for NFCC-affiliated agencies, can help you navigate debt management plans if things have gotten significantly out of hand. Balance transfers and 0% offers can buy time, but only if you are also addressing the underlying spending issue. Section 17. The credit card payoff strategy. If you are currently carrying credit card debt, this section is for you. Let me be direct and compassionate about this. Credit card debt is stressful. It has a way of sitting in the back of your mind, adding a low hum of anxiety to daily life. And the interest makes it feel like you are running on a treadmill that is slowly accelerating. I want you to know that this situation, while serious, is genuinely solvable with a clear strategy. There are two main frameworks for paying off multiple debts, and they each have psychological and mathematical implications. The first is the avalanche method. You order your debts from highest interest rate to lowest. You pay minimums on everything and throw every extra dollar you have at the highest rate debt. Once it is paid off, you roll that payment to the next highest rate. Mathematically, this is the fastest way to pay off debt and the lowest total interest paid. The second is the snowball method, popularized by Dave Ramsey. You order your debts from smallest balance to largest, regardless of interest rate. You pay minimums on everything and throw extra at the smallest balance first. Once it is paid, you roll to the next smallest. Mathematically, this is not optimal. You might pay more in total interest, but psychologically, it generates early wins. Paying off an entire account, even a small one, creates momentum and a sense of progress that helps people stay motivated. Research on behavior and debt repayment suggests the snowball method leads to better completion rates for many people. Motivation matters more than math if the math approach makes you give up. Know yourself. A third approach, which we touched on earlier, is the balance transfer. If you can qualify for a 0% balance transfer card, moving high-interest debt to that card can save significant interest while you pay it down. The key is having a concrete plan to pay off the balance within the promotional period and stopping new spending on the original cards so you do not accumulate new debt in parallel. Whatever method you choose, the single most powerful thing you can do to accelerate payoff is increase your monthly payment. Any amount above the minimum makes a dramatically non-linear difference because of how compound interest works. If you are paying $50 a month on a $2,000 balance, increasing to $150 might cut 6 years and thousands in interest off your payoff timeline. That is the kind of impact small payment increases make. Some people use a debt thermometer approach, a visual tracker where you color in progress as you pay down the balance. This sounds childish. It actually works. Making abstract financial progress visible and concrete activates motivation centers in the brain that abstract numbers do not. If it works for you, it works. One thing I want to address directly: the shame spiral that often accompanies credit card debt. The self-judgment, the "I should have known better," the "what is wrong with me," the hiding it from partners or family. This shame is understandable and also counterproductive. Shame rarely motivates behavior change. It tends to create avoidance and paralysis, which makes debt situations worse. You got into this situation through some combination of circumstances and behaviors. Understanding both without judgment is what allows you to change course. Every person I have seen successfully pay off significant debt approached it, not with self-flagellation, but with the same focused pragmatism you would bring to any other solvable problem. Section 18. Credit cards and relationships. Money is the #1 cause of conflict in relationships, and credit cards, specifically, are a flashpoint. Maybe one partner uses credit cards freely and the other is uncomfortable with them. Maybe there is different financial history. One person grew up in a household where credit card debt was normal and unthreatening. Another grew up watching a parent struggle with debt and has deep-rooted anxiety about it. Maybe one person has a lower credit score because of things that happened before the relationship, and now joint financial applications are complicated. These conversations are hard, but avoiding them is harder over time. A few things worth discussing with a partner if you share finances. How will we manage credit cards? Individually or jointly? Joint credit card accounts, where both people are co-applicants and both bear equal legal responsibility, versus authorized user arrangements, where one person is the primary account holder and adds the other as a user with their own card on the account. These have different implications for credit, liability, and decision-making. Know which you are choosing and why. What is our agreed spending threshold before we consult each other? Some couples have a rule: any individual purchase over $200 or $500 requires a conversation first. This is not about distrust. It is about alignment and preventing financial surprises. What happens if we separate? Joint credit card accounts are complicated by breakups and divorces. Both people remain legally responsible for the debt, even if one person is actually using the card. Decoupling joint credit accounts requires either paying off the balance and closing the account, or one person refinancing it into their sole name, which requires their creditworthiness alone to qualify. The underlying principle here is this: financial transparency is a form of intimacy. The couples who navigate money well are not the ones who never disagree. They are the ones who communicate regularly about money, have shared awareness of their financial picture, and make decisions together rather than in parallel. Section 19. Navigating the system as a first-generation credit user. I want to speak directly to people who grew up in households where credit cards were either not used badly, or were associated with stress and difficulty. If your parents did not have credit cards, or if you watched someone in your family struggle because of credit card debt, you might carry an inherited skepticism or anxiety about credit that is both understandable and worth examining. The skepticism might be completely warranted based on what you saw, but it might also be based on a system that was not fully understood, and understanding changes the risk profile dramatically. At the same time, there are real structural challenges for people who did not have credit in their family. You might be starting with no credit history at 25, while a peer from a different background was added as an authorized user to their parents' card at 16. And has been building credit history for nearly a decade. That gap is real. It affects your initial access and options. The practical path forward is the same one we discussed earlier. Start with a secured card or credit builder product. Build history consistently, and be patient. The structural disadvantage is real, but it is not permanent. It is also worth knowing that there are credit scoring models being developed that incorporate non-traditional payment data, rent payment history, utility bills, cell phone bills, in an effort to give credit to people who have been reliably paying their obligations for years without it showing up in traditional credit history. These programs are still evolving, but they represent a meaningful step toward a more inclusive credit system. Section 20. Practical takeaways. All right, we have covered a lot of ground. Let me bring it together into practical, actionable reality. Not a list of tips, but a real picture of how to actually live with this knowledge. If you are just starting out, get a starter credit card. Secured or student. Use it for 1 or 2 small regular purchases per month. Pay the full balance every month without fail. Set up autopay for the full statement balance if your bank allows it. Do not think about rewards yet. Think about building a clean history. Do this for 12 to 18 months. That is your foundation. If you are in debt, stop adding to the balances. Even pause the rewards optimization. None of that matters while you are paying 22% interest. Look at all your cards. List your balances and interest rates. Consider a balance transfer if you can qualify. Pick your payoff method, avalanche or snowball. Commit to a specific monthly payment above the minimum. Find any dollars you can redirect. A subscription you forgot about. A spending category you can reduce temporarily. Give yourself a clear timeline and track your progress visually. If you are in a stable place and ready to optimize, pull your last 3 months of credit card statements. Categorize where your spending actually goes. Research 1 or 2 cards that match your actual spending pattern. Apply thoughtfully. Not for every card that looks good, but for 1 or 2 that clearly make sense. Set up the right autopay. Review your annual fee cards each year when the fee hits. Is it still worth it based on how you actually used it? The utilization trick. If you want to optimize your credit score, pay your credit card balance before the statement closing date, not just by the due date. The balance reported to the credit bureaus is usually the statement balance on the closing date. If you pay it down before that date, your reported utilization is lower, and your score benefits. This does not require carrying a balance. Pay most of the balance mid-cycle, have a very low statement balance reported, and then pay the rest on the due date. On checking your credit, check your credit reports at least once a year minimum. Look for errors. Look for accounts you do not recognize. That can be a sign of identity theft. Your score is available for free through many credit card apps, through Credit Karma, Credit Sesame, and various bank apps. You do not need to pay for your credit score. On annual fee reviews, every year when your high-fee card's annual fee posts, do a 5-minute calculation. What benefits did I actually use this year? What is their dollar value? Does that exceed the annual fee? If yes, keep the card. If no, call the issuer. Sometimes they will offer a retention bonus, points or a statement credit, to keep you. If the math does not work even with that, downgrade to a no-fee version of the card rather than closing it to preserve the credit history. On travel cards, do not get a travel card unless you actually travel. or unless the benefits translate into real value for your actual life. Airport lounge access sounds glamorous, but if you fly once a year, you will enter the lounge once a year. The card needs to work for the life you have, not a hypothetical version of your life. On credit card apps and alerts, set up spending alerts and balance alerts through your card's app. A push notification when a charge over $50 hits your account is a small but useful way to stay connected to your spending and catch fraud early. You can usually customize these thresholds. Section 21. The emotional relationship with money. I want to slow down here before we close, because I think this matters. We talk about credit cards and personal finance as if they are purely rational subjects. Run the math, optimize the rewards, watch your utilization. But in my experience, personal finance is not primarily a mathematical problem. For most people, it is an emotional one. Our relationship with money, the anxiety we feel, the avoidance we practice, the shame we carry, the exhilaration of a good financial decision. These are emotional experiences shaped by our history, by what we watched our parents do with money, by financial scares we have had, by cultural messages about what money means about our worth, our success, our safety. Credit cards sit right at the intersection of all of that. They amplify both our good habits and our struggles. They are visible, frequent, emotionally charged. I want you to know that wherever you are in your financial life, whether you are thriving and optimizing, or you are in a hole and trying to find your way out, or you are somewhere in the messy middle, you are not uniquely broken. Financial struggle is extraordinarily common. The shame that so often accompanies it is disproportionate to the actual moral failing involved. Most credit card debt comes from some combination of income that does not match the cost of living, emergencies that we're not prepared for, systems that were not understood, and moments of human weakness that are utterly predictable and universal. Understanding the system, which is what we have tried to do in this video, is one part of the answer. The other part is being compassionate with yourself about the parts you did not get right, not as an excuse to not try harder, but as the emotional permission you need to actually make changes without the paralysis that shame creates. Section 22. Closing reflection. We have been in this for a while, and I want to close in a way that is honest and human. Credit cards are not the whole story of your financial life. They are one chapter. And depending on where you are right now, they might be a small chapter or a loud one. Either way, they are manageable, they are understandable, and after everything we have walked through today, they should feel a little less mysterious. If you walked in here feeling anxious about your credit card balance, I hope you now have a clearer picture of what is actually happening and what your options are. Not just pay it off, but a real specific path. If you walked in curious about rewards and whether you are leaving money on the table, I hope you have a framework now for evaluating what cards actually make sense for your actual life. If you walked in with decent habits but gaps in your understanding, the stuff about utilization timing, or grace periods, or balance transfer mechanics, or card benefits you did not know existed, I hope that knowledge feels like it is yours now. Here is what I want to leave you with. Financial improvement is not a binary flip. You do not wake up one day financially bad and then get this one piece of information and become financially brilliant. It is gradual. It is incremental. It is a series of slightly better decisions made over time that compound, just like interest, but in your favor. You do not need to get everything right at once. You need to know enough to take the next right step, and then the one after that. Maybe today's step is pulling your credit report for the first time and actually reading it. Maybe it is calling your issuer about a hardship program. Maybe it's calculating what you are actually earning in rewards versus paying in fees. Maybe it is just setting up autopay so you never miss a payment again. Whatever it is, that step is available to you right now, today, and progress, however small, however imperfect, is still progress. Take care of yourself. Take care of your money. Not because money is everything, but because financial stress drains the energy you need for everything else that actually matters. See you in the next one.